What's up, guys? Welcome back to the channel. Today I want to talk about double bots, double tops, and basically explaining to you why, in my opinion, it's not the best way to trade, but how you can use it in your advantage to actually build a profitable trading strategy. So let's get started. All right, so we are looking at the pound yen right now. And if you're familiar with the Wyckoff method, this is just a big ass distribution range. I also discussed this setup with you guys a few videos back. This is where I shorted the pound yen. I'm already out, of course, but I shorted this pair. And what's interesting is that after this impulse moved to the downside, we had a double bottom forming. Now, if you know anything about my approach, I like to analyze where liquidity likely will be waiting. And to recap, liquidity usually is waiting below support, below double bottoms, and above equal highs, and above support, but also above and below, above key swing highs and below key swing lows. And you have to realize that a very big trader, if he wants to be short, he can't just go here and just open a new order and short 10,000 lots or something. He really needs to trade at smart areas because of liquidity purposes. Now, we know that they like to trade around areas of high liquidity, but they also like to scale in their orders. They cut it into pieces and just scale it into the markets at around the same price, usually done by algorithms. And that way they can just enter the market without pushing price against themselves. And that's something to realize. That's also a bit of the basis behind Wyckoff. The Wyckoff method basically tells you about how supply and demand is being absorbed at certain areas. And you can identify if there's a bigger player doing this. And if you do that correctly, you can get great trades. So to put this into perspective, this is usually a market cycle. You start with accumulation, then a breakout, reaccumulation, often even another reaccumulation pattern, and then the distribution pattern. I don't know why it says accumulation. This is distribution, redistribution, and then we get back to accumulation. Now, if we go back to the GBP GPY, this is your distribution, and a lot of people usually buy in this area because they think it's accumulation, and this is where you will see double bottoms forming. More times than not, this is going to be redistribution, and you will see false, quote unquote, false support forming in this area. And it really surprises me that people that trade the Wyckoff method and see such big distribution range in this area think that this is accumulation. It's usually not. If there's a big distribution range, it doesn't end with just a small impulse move and that's it. And then we go to the uptrend. It's very, very rare. So if you see this distribution range, you should have a short bias and you should expect this to be a redistribution, even if you see a double bottom forming. So that's just a little tip I want to give you guys that trade the Wyckoff method, that generally speaking, you're going to see redistribution after a distribution range, and after an accumulation range, you're going to see reaccumulation. Not sure if I can get you guys a clean example of this. Let me check. Can't see anything clear right now, but that's generally speaking what happens. So if you see this, please start thinking about shorts instead of trying to long the double bottom. And also, you get liquidity building up here and here. And people that buy anywhere in this area usually put the stops below here. They tend to buy the breakout. And people that are short, that might be thinking they're smart, that short anywhere in this area, put the stops above these equal highs. Now look at what happens. Price tags the equal highs, breaks it, but doesn't follow through. And if people that had a stop loss above and buy and buy and buy, but the market doesn't go up, and instead of that just quickly falls back into the range, then it's a great sign that this is your UTAD in a redistribution range, and then that your liquidity above here has been absorbed by a bigger player. Because look at the aggression of the moves. This is not something that just a retail trader does. This is clear absorption of liquidity above the highs, in line with the big position that's usually been taken in this area in the distribution range. And at that point, at this red line, you know that something is up. There's a clean break back within the range. Then if you take a look here, where also liquidity will be resting because of these equal lows, and people that are bought this pair usually put the stops below. Look at what happens. Yes, we get a rejection, but we stay there. And then we don't really violently break back into the range like we have here. And then all of a sudden, close below that area. Now that tells you that you have to realize that two completely different things happen at these areas of liquidity. Here we have liquidity, we break above it, and then we stay above it and then quickly fall down. Here we break this area, we break back in the range, but we stay in this area. And then you would expect a quick follow through if there's a bigger player absorbing liquidity, but it just closes below this low, and then the rest of the story you can tell yourself. But that's a big difference, and that's something you need to realize, that if there's a double bottom forming at those types of areas after a distribution, you definitely don't want to be looking for a long. In my opinion, it's a low probability setup. So that's it about double bottoms and double tops in combination with the Wyckoff method. Now I do want to talk about support and resistance trading. If we look here, look at that, clean support. So people, especially beginners, just tend to buy support and basically hope for the best. But what you usually get at key areas of support is a break below. And you really want to look, let's take a look here. Look at that. There's a quick break below and then a rejection. Then break below the low and a quick move up. So what you want to do at key levels of support and resistance, especially if you were wanting to buy support, let's say price is here and you want to buy support below market. So I'm not talking about breakout of a range and then this becoming support. I'm talking about supports at swing points. So you want to buy this support level. What you generally see is price breaking those areas, and only then after it broke it, then you see it tanking. So what you want to look for, if you don't already have a strategy, is to develop a trading setup that you look for below, just below support or at support, but you wait for a break of support, because that usually increases your probability if you trade at such areas. And why? Basically because of the same thing that we have here. So you have this key swing low, and people tend to put the stop losses below there. So if they are long anywhere in this area, they tend to put the stop below the swing points. And that's such an obvious spot, and it still happens that this is where a lot of liquidity is stacked. And I'm not only talking about small retail traders, there are also prop firms and bigger firms that place their stops at these places for whatever reason. Probably because it fits their plan. But with that aside, you can expect liquidity to be below support, not at support. And as we all know, price tends to move to areas of liquidity from one area to the other. So if you're looking to buy this, look for a break below and then a quick rejection. Look for absorption of liquidity, just like we had seen above these equal highs. Look for the same thing happening if you want to buy support at those areas. and then develop a strategy around it. My strategy is around 90% mechanical. It used to be 100%, but I do add some discretion right now because I've been trading it for so long, and I've noticed certain things lining up that increase my probability of success. So if I see my setup happening just below a swing low, a key swing low, I know my probability of success is way higher than if it is just at a random place. So it's always about the setup and the location. This would be a great location to look for a false break to the downside, like we have seen here. Yes, this is hindsight, but I did mark this level out way before on my trading. And as you can see, the same thing happens here. You got this key swing low, price runs into it, breaks it, and then takes off. So anyone that just buys support blindly here and just puts a stop below gets fucked. But if you just are patient and you develop an entry setup that you look for, maybe on the lower time frames, below these key levels, you can see you can really get a nice move. So that's a little tip I want to give you guys, to start experimenting with yourself. And usually, if you look for a strategy, the best thing to look for is a break below and then a close above the level. Then often this is going to be the bottom, the local bottom that has been formed, and then you can look for an entry. So that's a tip right there, guys. And I hope you enjoyed this video. Hope you learned something. If you have any questions, let me know down in the comments below. And also let me know what type of videos you really enjoy, because lately I've been putting out a lot more trading videos. But do you also want a bit more informational videos via a presentation, maybe webinar style? Let me know, and then I create some content for you guys. So thanks for watching, and see you in the next one.